Welcome back to Talk Tickers. This is the show where we stop pretending that reading a headline makes you an informed investor. We are here for the signal, we are ignoring the noise, and we are absolutely digging into the machinery of the market.
That's right. And today, we are looking at a company that, it literally feeds a massive chunk of the planet, yet somehow manages to confuse Wall Street every single quarter.
We are talking about Pilgrims Pride, ticker symbol PPC, and we are breaking down their fiscal year 2025 fourth quarter earnings.
And if you're looking at the tape, you know exactly why we picked this one. The stock is down roughly, 4% in after-hours trading?
Yeah, it's hovering right around $42. And honestly, the market reaction feels a bit like a temper tantrum. It's messy.
It is messy. It feels like a classic case of cognitive dissonance. You look at one side of the ledger and things are booming.
Right.
Then you look at the other side and profitability is just evaporating. It's this core conflict of volume versus margin.
That is the tension defining the entire protein sector right now. On the top line, Pilgrims beat expectations, revenue is up, people are buying chicken like it's going out of style.
They absolutely are. But then, on the bottom line, a miss on earnings per share, margins compressed. So the fundamental question we have to answer over the next hour is, if demand is so high and corn prices, which is their biggest cost, are dropping, why aren't they printing money?
That is the billion-dollar question. Because theoretically, this should be the sweet spot. You have cheap inputs, high demand, and a competitor product beef that is historically expensive.
It should be a Goldilocks moment.
It should be, but it's not. Instead, we have a situation where they are running faster just to stay in the same place.
And we need to dissect why. Why cheap corn isn't saving the P&L yet. We have to look at the absolute disaster that occurred in their Mexico segment. And we need to talk about why they are planning to spend nearly $1 billion in CapEx next year when their margins are shrinking.
And of course, stick around for the end. We have a This Is Not Financial Advice segment that I think is my favorite one yet.
Oh, yeah.
We are pitching a trade based on rooster fertility and genetic bottlenecks.
It is a wild thesis, but the data actually supports it. But we'll get to the biology later. We have to start with the accounting.
Let's do it. Walk me through the Q4 results snapshot. I want to know exactly where the bleeding happened.
Okay, let's look at the headline numbers first. Revenue came in at $4.542 billion.
Yeah, okay. And the street was looking for what?
The street consensus was $4.40 billion. So they beat the top line by about $120 million. Year over year, revenue is up roughly 3.5%.
Which confirms the demand story. The cash register is ringing. They are moving product.
They are moving a lot of product. But that is where the good news stops. If you look at adjusted earnings per share, they posted 68 cents.
And consensus was 74. So a miss.
A solid miss. But the real shocker is the GAAP EPS. It came in at 37 cents. A year ago, that number was 99 cents.
Wait, hold on. That is a massive deterioration. Going from 99 cents to 37 cents year over year?
It's a 60% drop.
That's a 60% drop in GAAP earnings. What is driving that wedge?
It's a combination of, some one-time items and a lot of operational drag, but the cleanest way to view the health of the business is usually adjusted EBITDA. That came in at $415 million.
415, okay.
But the metric that triggered the sell-off is the margin. The EBITDA margin was 9.2%.
And for context, what is a healthy margin for Pilgrims in this environment? What were they at last year?
In the prior year quarter, they were at 12%.
Wow.
So you've lost nearly 300 basis points of margin in a year where sales went up.
That is the definition of profitless prosperity.
It is. And if you look at GAAP operating margin, it's even thinner, down to 4.5%.
This is what I struggle with. Management is touting efficiency. They are touting strong demand. But for every dollar they bring in, they are keeping significantly less of it than they did 12 months ago.
Right.
Is this an industry-wide problem, or is this a Pilgrims Pride execution problem?
It's a little bit of column A, a little bit of column B. The industry headwinds are really specifically in the commodity segments, which we will get to. But Pilgrims had some specific blow-ups, particularly in their international unit, that really dragged down the consolidated number.
Okay, before we get into the segment breakdown, I want to touch on the balance sheet. When a company misses earnings and forecasts huge spending, my first worry is debt. Are they overleveraged?
Surprisingly, no. The balance sheet is a fortress. They have been very disciplined about paying down debt over the last cycle.
Really?
Yeah. Net debt is sitting at 1.1 times LTM EBITDA. For a capital-intensive business like poultry, anything under 2 times is considered safe. 1.1 is very conservative.
So they aren't answering to bondholders right now. They have flexibility.
Not at all. They have over $1.8 billion in liquidity cash on hand plus their revolver. And they don't have any major bond maturities until 2031.
So the sell-off isn't a solvency fear. No one thinks Pilgrims is going bankrupt.
No, not at all. The sell-off is entirely about earnings power. Investors are looking at this and asking, if you can't hit a double-digit margin when beef is $8 a pound, when can you?
That is a fair question. Let's pivot to that U.S. market dynamic. We keep hearing about the trade-down effect. Is it actually showing up in the data? Or is it just something CEOs say to make themselves feel better?
It is absolutely in the data, and it's showing up in a very specific way. Management spent a lot of time discussing consumer behavior. Inflation has just wrecked food away from home. Going to a restaurant, even a fast casual place, has become a luxury for a lot of working-class families.
So they are retreating to the grocery store.
Correct. But even at the grocery store, behavior has changed. Management noted that trip frequency is up, but basket size is down.
Interesting. So more trips, less stuff per trip.
Exactly. People are shopping more often, buying less per trip, and really hunting for value. They are managing their cash flow week to week. But the one department that is winning in this environment is the meat case.
Specifically chicken.
Specifically chicken. And this brings us to the most important macroeconomic chart for this company, the price spread.
Okay.
Management highlighted that ground beef prices are up roughly 22% compared to 2 years ago. We are hitting all-time highs for beef.
Yeah, because the cattle herd is at a 50-year low, right?
Exactly. The cattle cycle is long. You can't just 3D print a cow. It takes years to rebuild the herd. So beef supply is structurally tight, driving prices up.
Okay, so that's the beef side. What about chicken?
Now, compare that to boneless chicken retail prices. Over that same 2-year period where beef went up 22%, chicken retail prices are actually down about 1.7%.
Like down, so the gap is widening from both ends.
Yeah.
Beef gets more expensive, chicken gets slightly cheaper.
The spread is nearly $2 per pound.
Wow.
That is historic. Management called it a structural floor for chicken demand. Even if the economy rolls over into a hard recession, people have to eat. And when they look at the math, chicken is the only protein that fits the budget.
Okay, so the macro setup is bullish. But Pilgrims isn't just selling generic chicken. They have been pushing this just Bear brand very hard. I see it at Costco. I see it at Target. Is it actually moving the needle, or is it just a nice marketing slide?
It is the star of the show. This was the most bullish data point in the entire print. Just Bear retail sales surpassed $1 billion across their fresh and prepared categories.
$1 billion brand. That puts it in the big leagues of CPG.
It does. And what's impressive is the velocity. They grew market share by nearly 300 basis points. Management claimed it is the highest velocity brand in frozen chicken.
And this matters because branded products carry higher margins, right?
Higher margins and, more importantly, customer loyalty. If you are selling generic breast meat, you are fighting over pennies. If you are selling just Bear nuggets, you have pricing power.
So the retail side, the grocery store side is booming. But Pilgrims is a massive company. They have other segments in the U.S. that aren't doing as well. We have to talk about Big Bird.
Right. And to clarify for the listener, Big Bird isn't a nickname for a specific factory. It's an industry term. These are large broilers grown to 9 pounds or more, specifically for the deboning market. This is meat destined for food service, industrial processing, making nuggets for fast food chains.
Basically the commodity engine of the poultry industry.
Exactly. And the engine stalled. Cutout values for this segment fell nearly 20% year over year.
20%. Why? If retail demand is so strong, why did the industrial side crash?
It's an oversupply issue, specifically in that weight class. You had high availability of deboning meat, and when you combine that with some softness in food service, traffic, fewer people going to drive thrusts, the pricing power collapsed.
So a 20% drop in cutout values is just a massive hit to revenue for that segment.
Huge. And this explains the margin compression. The high-margin branded stuff grew, but the massive volume commodity stuff plummeted. It diluted the mix.
Got it.
But here is where it gets interesting from a strategy perspective. Management isn't just sitting there taking the price hits. They are actively converting these Big Bird plants.
Converting them to what?
To support the prepared foods business and case ready. Basically, they are looking at that cheap meat and saying, Why should we sell this on the open market for a 20% loss?
Let's use it ourselves.
Let's keep it, process it ourselves, turn it into a value-added product, and sell it at retail.
That sounds logical, but isn't that incredibly expensive? You can't just tell a factory to stop making giant birds and start making retail trays. The equipment is different. The line speeds are different.
It is hugely expensive, and that is part of the CapEx story we'll discuss later. They are converting a big bird plant to a case-ready plant right now. That involves ripping out deboning lines, installing packaging equipment, and changing the entire flow of the facility.
So it's a defensive move.
Very defensive. They're trying to reduce their exposure to that volatile commodity pricing.
It seems like the right long-term play, but it definitely hurts cash flow in the short term.
Yeah.
What about the small bird segment? The fast food chicken sandwich wars. Is that still a thing?
The wars have cooled off. You don't see people lining up around the block for a Popeyes sandwich anymore, but the volume has stuck. Management noted that boneless dark meat is growing double digits in food service.
Boneless dark meat, like thighs.
Thighs, mostly. Historically, the U.S. market rejected dark meat. We exported it to Mexico or Russia. But inflation has forced U.S. consumers and restaurants to embrace the thigh. It's cheaper, it has more flavor, and now you are seeing boneless thigh sandwiches or dark meat nuggets on menus.
Yeah.
That is a structural shift in the U.S. palate that benefits producers like Pilgrims because it raises the value of the whole bird.
So the U.S. story is mixed. Retail is great. Commodity is terrible. But the consumer is shifting toward chicken. Now, we have to talk about the disaster.
Yeah, there's no sugarcoating this. Mexico was a catastrophe this quarter.
Give me the numbers. How bad was it?
In the fourth quarter, adjusted EBITDA for the Mexico segment was $9.5 million.
$9.5 million. That sounds low. What was it last year?
$36.9 million.
Oh, wow. So it fell off a cliff. The margin fell to roughly 2%. For a market that has historically been a cash cow, often printing double-digit margins running at 2%, is basically break even.
Yeah, it's terrible.
What happened? Mexico is usually their high-growth, high-margin region. Did the consumer stop eating chicken?
No, consumption is fine. This was a supply-side shock. Management called it a perfect storm. It was a combination of imports flooding the country and domestic overproduction.
Let's break that down.
All right.
Imports from where?
Primarily Brazil and the U.S. Brazil is the largest chicken exporter in the world. When global trade flows get disrupted, that Brazilian chicken looks for a home.
Right.
The exchange rates were favorable, so Brazilian breast meat flooded into Mexico. At the same time, you had pork imports coming in from the U.S.
And then you had the domestic issue. Management mentioned favorable growing conditions, which sounds positive, but in agriculture, that's usually code for we made too much.
Exactly. In the central region of Mexico, the weather was mild, mortality rates dropped, birds grew faster and bigger than expected. So suddenly, every producer in central Mexico had more tonnage than they planned for.
So you have a flood of imports and a flood of domestic supply hitting the market at the exact same time.
And pricing collapsed. Economics 101. Supply exceeded demand and prices cratered.
Is this fixable? Or is Mexico structurally broken?
Management thinks it's fixable, but it requires a strategic shift. They're trying to diversify away from that crowded central region. They're pouring money into the south, specifically Veracruz and the peninsula region, Mérida.
Why the South? What's the logic there?
It's less penetrated. The logistics are harder for importers to reach effectively compared to the north and central areas. By building capacity in the south, they're trying to create a domestic moat.
Got it.
Their goal is to reduce Mexico's reliance on imports by 35%.
So they want to be the local provider for the South, shielding themselves from the global commodity flows.
That's the plan. But building plants in Veracruz takes time and money. So Mexico is going to be a show-me story for at least the next few quarters. Investors hate volatility, and Mexico just introduced a massive amount of it.
Let's fly across the Atlantic. Europe. Given the economic headlines out of the UK and the EU recession fears, inflation, I expected this to be a weak spot, but it wasn't.
No, Europe was the unexpected hero of the quarter. Adjusted EBITDA was up 12.2% year over year, hitting $131 million.
How? How are they growing earnings in a stagnant European economy?
It's an efficiency story. Remember, Pilgrims bought Kerry Consumer Foods a few years ago.
Right.
They've been doing the hard work of integrating, consolidating bag offices, closing inefficient lines. Those operational improvements are finally hitting the bottom line. They're just running a tighter ship.
But there was this weird detail about pork. I saw mention of African swine fever in Spain affecting your sausage business. Can you connect those dots for me?
This is a fascinating example of how interconnected the global food system is. So Pilgrims owns the Richmond brand in the UK. It's famous for sausages, pork sausages.
Okay.
Spain is a huge pork producer. But right now, Spain is dealing with African swine fever, or ASF. Because of ASF, China, which is the world's biggest pork buyer, has banned Spanish pork imports.
So Spain can't sell to China. All that pork is stuck.
Right. So all that Spanish pork has to stay in Europe. It floods the market. That drives the price of pork down across the continent. That cheap pork ends up in the UK.
Which sounds good for a sausage maker, no. Cheaper inputs.
It lowers their input costs, yes, but it also lowers the retail price on the shelf because everyone is discounting. It depresses the top-line revenue for the sausage category.
Ah, I see.
Yet, despite that deflationary pressure on their pork business, the Europe segment still grew earnings.
Because the chicken side was strong enough to offset it.
Exactly. The chicken business in Europe is growing 8 to 10%. The overall grocery market is growing at 4%. So chicken is taking massive market share from other proteins in Europe, just like in the US.
It really is the universal truth of this call. Whether it's the UK, Mexico, or the US, chicken is winning the relative value war.
It is. The consumer is voting with their wallet, and they are voting for chicken.
Okay, let's go deeper into the mechanics. I want to talk about the supply chain and specifically the feed outlook. For a livestock company, feed is usually, what, 60% of Kaji's?
At least. It is the single biggest lever for profitability. And the news here is decidedly bullish. Corn prices moderated significantly in January.
We had a record harvest, didn't we?
We did. The U.S. corn harvest saw record area and record yield. We are swimming in corn. The ending stocks are expected to hit 2.2 billion bushels.
And that's high.
That is the highest stocks-to-use ratio since 2019.
Explain stocks-to-use ratio for the listener who isn't a commodities trader.
It's a measure of inventory cushion. It compares how much corn we have left over in the silos versus how much we consume in a year. A high ratio means we have a massive buffer. When the buffer is big, prices stay low because there is no scarcity fear.
So corn is cheap. What about soybeans?
Same story. Favorable weather in South America means a bumper crop of soy. So the two main ingredients in chicken feed, corn for energy, soy for protein, are abundant and cheap.
So if input costs are crashing and retail prices are steady, margins should be expanding rapidly. Why aren't we seeing it in the Q4 numbers?
There is always a lag. We call it inventory flow through. The corn you buy today doesn't become a chicken nugget sold at Kroger for about 4 to 5 months.
Right, the whole life cycle.
You have to buy the corn, feed the breeder, feed the broiler, process it, and ship it. So the cheap corn from this harvest will really start helping margins in Q1 and Q2 of 2026.
So that is a tailwind for next year. But now we have to talk about the headwind, the biological headwind, hatchability.
This is the most critical topic in the industry right now.
I feel like we hear this every quarter. Hatchability is down. What is actually going on? Why can't these companies just hatch more eggs?
We have to get into the genetics to understand this. For the last 20 years, the industry has bred chickens, for one thing. Breast meat yield. They wanted big, heavy birds with massive pectoral muscles because that's what the consumer wanted.
The Arnold Schwarzenegger of chickens.
Basically. But there is a biological trade-off. As you breed for size and rapid weight gain, reproductive efficiency drops. The roosters literally get too big and lethargic to breed effectively.
Wow.
The hens lay fewer eggs, and the eggs they do lay are less viable.
So we hit a genetic wall?
We hit a ceiling.
Yeah.
Hatchability, the percentage of eggs that actually hatch into chicks, is tracking below 5-year averages. It keeps grinding lower.
And the data supports this.
The data is stark. Management noted the breeder flock is down 1.9%. But the scarier number is pullet placements.
Define pullet placements for me.
A pullet is a young hen destined to become a breeder. These are the grandmothers of the food supply. Pullet placements were down 3.1% in Q4.
That is a leading indicator. If you aren't placing pullets today, you don't have breeder hens in 6 months, and you don't have broilers in a year.
Exactly. It bakes in a supply constraint for the next 12 to 18 months. Because of this, the USDA predicts only about 1% production growth for the entire industry in 2026.
This is fascinating. Usually in a commodity cycle, when margins are good or expected to be good, everyone expands. They build more barns, grow more birds, and crash the price.
Right, the classic boom-bust.
You are saying they can't expand?
Biology is preventing the bust cycle. They physically cannot generate enough chicks to flood the market.
So putting this all together, feed costs are dropping, which is bullish.
Yeah.
Demand is high because beef is expensive, which is bullish. And supply is capped by genetics, which is also bullish.
That is the long thesis. It is a perfect storm for margin expansion.
But the stock is down.
Because investors are impatient. They see the Q4 margin compression and the mess in Mexico, and they ignore the setup for 2026. They want to see the proof before they believe the thesis.
Well, Pilgrims is certainly betting on the future. Let's talk about capital allocation. Because they aren't hoarding cash, they are spending it.
It is a massive spike in spending. The 2026 CapEx forecast is $900 to $950 million.
Nearly $1 billion. That is a huge jump from the $700 million in 2025.
It is. And in an industry with thin margins, that is a lot of free cash flow being diverted.
Where's the money going? Please tell me it's not stock buybacks.
No, this is hard asset investment. A few key buckets. First, a new prepared foods facility in Georgia Walker County. They are doubling down on the Just Bayer momentum. They need more capacity to make nuggets and patties.
Okay, that makes sense. Chase the high margin growth.
Second, the Mexico expansion we discussed, building those plants in the south to diversify. And third, the big bird conversion, retooling those massive plants to do retail packaging.
So these are strategic projects. They aren't just repaving parking lots.
Correct. But here is the risk. This is a heavy investment cycle. It means that for 2026, free cash flow is going to be crimped. They are spending the cash now to build earnings power for 2027 and 2028.
And Wall Street usually prefers cash now.
Especially when the current quarter was a miss. It's hard to ask investors for patience when you just miss earnings. It requires trust in management's vision.
Let's quickly run through the rest of the guidance before we get to the trade idea. Interest expense.
115 to 125 million. Very manageable given their low debt load.
Tax rate.
About 25%.
Standard.
Depreciation.
This is ticking up. Tracking to $520 million. That reflects all the new equipment coming online.
Okay. And SG&A. Administrative costs. Run rate of about 140 million per quarter. It's worth noting that last year's numbers were messy because of litigation settlements. They paid out about 77 million. That's in the rearview mirror now, so the SG&A line should look cleaner and more consistent going forward.
So let's summarize the investor context. Why the sell-off? Why is the stock down 4%?
It comes down to one thing, margin durability. Revenue beats are nice, but if you make less money on more sales, Wall Street gets nervous. It raises questions about whether the business model is leaking leverage.
And the Mexico volatility clearly spooked people.
Absolutely. Investors hate what they can't model. Mexico going from a $36 million EBITDA contributor to $9 million in a single quarter is terrifying for a model. It introduces a wildcard risk that warrants a discount on the stock price.
But the bull case is still sitting right there. It feels almost obvious.
The bull case is stronger than ever, fundamentally. Feed costs are a massive tailwind waiting to hit the P&L. The beef inflation gives them a pricing umbrella.
And the brand is working.
And the Just Bear brand is working. If they can execute on these plant conversions, they become a much more stable, higher margin business in 2 years.
So what's the bear case? What could go wrong?
The bear case is that the U.S. supply glut happens anyway. Maybe hatchability miraculously improves, or that Mexico takes years to fix, or that they just screw up the execution on these billion-dollar construction projects. Construction delays are real, cost overruns are real.
It is a transition year. 2026 is clearly an investment year.
It is. You own this stock if you believe in the 2027 earnings power, not the Q1 2026 earnings.
Right. We have analyzed the numbers. We have dissected the biology. We have debated the strategy. Now it is time to get creative.
My favorite part of the show.
It is time for our This is Not Financial Advice segment.
Disclaimer. This is absolutely not financial advice. Do not trade based on what we are about to say. This is for entertainment and theoretical application only. If you lose money because you listen to a podcast, that is on you.
Set the scene for us.
Okay. You are a portfolio manager at a multi-strategy hedge fund. You are pitching the investment committee. You need an idea that is uncorrelated to the S&P 500.
I'm in.
You slam a binder full of rooster data on the table.
What is the trade?
I call it the genetic bottleneck protein spread arb.
I love it already. Walk us through the legs of the trade.
Leg one, you go long Pilgrims Pride, PPC calls. We are looking at EPS long-term options. You are betting that the margin expansion is inevitable because corn is going to $3.50 and chicken prices are sticky because beef is too expensive.
That's your directional bet on the profitability catch-up.
Exactly. But a directional bet is risky. How do we hedge it?
Okay.
Leg 2, your short-lived cattle futures.
Shorting beef.
Exactly. You are betting on the spread reversion. Either beef prices have to come down because the consumer breaks, or chicken goes up to meet it. By shorting cattle and longing chicken, you are trading the spread between the proteins. You are capturing the relative value.
Smart. If the economy tanks and all protein crashes, the cattle short pays out and covers your chicken losses.
Precisely.
Yeah.
But here is the twist. The alpha leg.
The infertile rooster component.
Yes. I call it the hatchability hedge.
Go on.
The thesis is that the industry cannot fix the fertility issue. We are betting against any increase in pullet placements. Now, you can't trade pullets directly on the CME, but you can trade the proxies.
How?
You find a counterparty, maybe an OTC swap if you're big enough, or you structure a trade using short soybean meal futures.
Why short soy?
Because if the flock can't grow, they don't eat. If hatchability stays low, the demand for soybean meal, which is the main protein source for birds, will disappoint the market.
Yeah.
Everyone expects flock growth. We are betting on flock stagnation.
So you are long the chicken producer, betting on margins, short the competing protein, which is beef, and short the input demand, soy, because you believe the biology is broken.
Exactly. You are longing the biological constraints of the poultry industry against the macroeconomic inflation of the beef industry. It is a genetic arbitrage.
That is wildly sophisticated and completely outrageous.
It's the kind of trade that gets you a legendary bonus or fired immediately.
I love it. But again, please do not trade biological derivatives based on a podcast.
Please don't. Stick to index funds.
All right, let's bring it home. Recap for the listener who's just tuning in.
PPC Q4. Sales good, margins bad. Stock down about 4%. The consumer is trading down to chicken, but operations need to tighten up to capture the profit. Mexico is a mess, but Europe is a surprise winner. And 2026 is an investment year with nearly $1 billion in CapEx.
What is the final thought? What is the one thing they should watch on their terminal next week?
Watch the spread. As long as beef is 22% more expensive than 2 years ago, the floor is in for chicken. And watch the pullet placement data from the USDA. If that number stays negative, the bull case is alive.
Fantastic deep dive today. Thanks for listening to Talk Tickers. We will catch you on the next print.
See you next time.